Hello and welcome to Inside ETFs. I'm Ramzan Karamali. Today we're looking at healthcare ETFs and my guest is Shana Sissel, founder and CEO of Banrion Capital Management. The healthcare sector was a weak performer in 2023 and so far this year it still lags the performance of the broader market. Year to date, the S&P 500 healthcare index is up around a tenth. That's roughly half the return of the broader S&P 500. One healthcare ETF that is outperforming the rest of the sector is the Simplify Healthcare ETF, or PINK. All net profits from it are donated to the breast cancer charity, the Susan G. Komen Foundation. But is this one for investors? Well, to help answer that and more, I'm joined by Shana Sissel from Banrion Capital Management. Shana, let's start with PINK. From your notes, I can see that you like it, but apart from attracting investors to a charitable cause, what else makes it an attractive investment in your opinion?
Well, everything is great when you have a charitable cause associated with it, obviously. But in investing, there needs to be a good, solid return as well. The Pink Fund has both. So it is run by Michael Taylor, who is an extremely experienced healthcare manager who has run long-short healthcare funds for hedge funds for decades. And prior to joining the investment management world, he was actually a scientist that worked on drug development. So he's extremely experienced in evaluating drug technologies, drug development. And he brings something really strong to the table in that sense. The fund has a very strong track record. And while it does donate its net profits to the Susan G. Komen Foundation for breast cancer research, it is not solely investing in companies related to breast cancer. It is a fully diversified healthcare ETF. And so you're getting a diversified basket of healthcare stocks that are chosen for their potential for outperformance. So you're getting the best of both worlds in many ways.
I said in my introduction also that the healthcare sector as a whole is underperforming the wider market. Why do you think that is?
I think that there's some concern in an election year. As you know, healthcare spending in the United States in particular is under a lot of scrutiny by our federal government. We just had some renegotiations of Medicare spend, and those things come under pressure under certain party leadership. Since there's so much uncertainty in how the outcome of the U.S. election will be and the impact it'll have on healthcare, I think that has been a primary reason for the headwind that healthcare stocks have faced at this time.
Now, looking at the biggest fund in the space, it's the Healthcare Select Sector Spider Fund, XLV. It's a passive option, though. Is that a problem here, that really investors should be looking for actively managed funds?
In healthcare, in particular, I do think that you need actively managed funds because there are a number of sub-industries within healthcare that can be quite volatile, biotech being the most commonly known of the volatile sub-industries. And you really need somebody that is going to be able to add value in those spaces. I think of it a lot like we would look at small cap stocks, where there's quite a bit of volatility and what you don't own is as important as what you do own. And in those cases, active management can make a lot of sense. If you look at healthcare ETFs performance over the last 24 months, actively managed healthcare ETFs have broadly done better than the passive. So I think in this space, it's worth looking at some of the active ETFs, also to take advantage of trends in the sector that the broader, bigger, passively managed ETFs can't necessarily give you exposure to.
Well, XLV, like many of the big healthcare ETFs, its top holdings and in fact its overall makeups are dominated by big names like the Eli Lillys and the Johnson & Johnsons. Do you think that's a good thing or a bad thing?
Again, I think the opportunity in healthcare comes from the areas that are overlooked, where you have that asymmetrical opportunity of having a very large performance opportunity, but they tend to be higher risk. Biotech, devices, anything that's in clinical trials that has potential to be a blockbuster. Trending areas like GLP-1s, those are areas that aren't necessarily represented well in those larger ETFs and passively managed ones where it's completely market cap related and it's just in the biggest names, but not necessarily the most innovative names.
You spoke earlier about trends as well. What fund out there do you think takes advantage of the major trend in the sector at the moment then?
So there's a fund, ticker symbol HRTS. It's the TEMA GLP-1 obesity and cardiometabolic ETF. It focuses solely on companies that are working with GLP-1s and anything related to obesity and weight loss. That is such a major trend right now. The biggest winners in healthcare have been in that space, and we are still very much in the early innings of the drug development in that space. We're learning more about the initial drugs that came out and some of the pros and cons, and those things are things that the next generation will probably look to address some of the cons. And so as we look at those things and we look at ways to optimize those GLP-1 drugs, there's a lot going on in that space in terms of development, and not just with the two big players in the space. So this ETF really looks to find the next iterations and the next beneficiaries of this trend to address the obesity epidemic that is now a global phenomenon.
Shana Sissel from Banrion Capital Management, many thanks for your thoughts. And that was your look at healthcare ETFs. I'm Ramzan Karmali, and this is Reuters.